So you're going to take a mortgage loan to finance the purchase of a property. It could be house, or it could be land, or it could be house with land. And you want to know how the appraised value factors in to the financing procedure. How the appraised value determines your ceiling, the ceiling of funds that are going to be offered to you in a mortgage loan. Precisely, you want to know how that appraised value ties into the entire process. So I'm going to show you with a couple examples how that appraised value does affect how much money you can get from your lending institution depending on their lending criteria. So stay tuned, we're gonna deal with that. We're gonna do some examples. So the first one is, what about if I'm going to a financial institution to buy a house and the asking price is $450,000. The lending criteria is 90% of the appraised value, and the appraised value is $500,000. Can this kind of loan for that be facilitated? Let's talk about it. So let's begin with this example. The asking or selling price is $450,000. The lending criteria of the financial institution is 90% of the value of the property, or 9% of the appraised value. Keep in mind, when I say value of the property and appraised value, this is the same thing basically. So the appraised value is $500,000. And as a result, the maximum value that can be lent by that institution to that client is 90% of $500,000. That gives a value of $450,000. So basically, the maximum value that can be lent is equivalent to the asking and selling price. So therefore, this loan can be facilitated by the financial institution. What about if the asking price is $450,000 and the lending criteria again is 90% of the appraised value, and the appraised value is $650,000? Can a loan for that asking price be facilitated? Let's explore it. Let's look at this example. The asking price is the same as the previous example, $450,000. The lending criteria is 90% of the value of the property, or also known as 90% of the appraised value. Now the appraised value for that property is $650,000. So based on the lending criteria, that institution can lend that client up to a maximum of 90% of $650,000, which is $585,000. The asking price is $450,000, so therefore that loan of $450,000 can be facilitated. And there's an extra $135,000 that can also be lent by an institution, and that's because the property, the appraised value, is so high above the asking or selling price that when that institution, if their policy allows for them to hold as security that property valued at $650,000, and their lending policy is 90% of the appraised value, they can now lend you up to $585,000. So you could you could actually access the $585,000, use $450,000 of that to pay the cost of the property, and you have $135,000 extra you could use to purchase a vehicle or another property. What about if the asking price is yet again $450,000? The lending criteria is 90% of the value of the property, 90% of the appraised value, and the appraised value is $400,000. Can a loan for that asking price be facilitated? Let's explore it. So let's look at this unusual scenario, and it's a very bad scenario to end up in. The asking price of $450,000. Lending criteria is the same, 90% of the value of the property and 90% of the appraised value. But after appraisal, it turns out that that property is worth $400,000. So the maximum the amount of money that can be lent by that financial institution is 90% of $400,000, which turns out to be $360,000. The problem is, because the appraised value was less than the asking price, that client is in a scenario where the property is not as valuable or not valuable enough to facilitate them lending the what is equivalent to the asking or selling price. They can only lend, the financial institution can only lend $360,000 based on the value of the property. It puts them in a shortfall. The client have $90,000. $90,000 cannot be facilitated because the property is not as valuable or not valuable enough to facilitate the extra $90,000. If you find yourself in this situation, the financial institution may require you to add more assets as collateral. So you may need more assets to be able to facilitate the $90,000 that cannot be satisfied under the appraised value of $400,000. So this is why I tell you all, make sure you have a very good idea of the appraised value of the property, a fair enough idea, even if you have to get undercover valuators to accompany you when doing a site visit. It is a good idea for you to be able to know that the appraised value is a bit higher than the asking price. Because if you sign up any documents that require you to pay a down payment of 10% and pay the balance within 3 months, and you go to the financial institution and you realize the appraised value is less than the asking or selling price, you are going to end up in this scenario. So we explored a couple of examples. Same asking price, same asking or selling price, same lending criteria of 90% of the appraised value, but different appraised values. Those three scenarios had different appraised values, and as you can see, there are different scenarios coming out of the lending institution analysis. So the appraised value does matter significantly in your success in getting financing for the purchase of your property. It's very important. You can't underestimate it. This is why I always tell you all it's very important to get a assessment. Have some colleague, relative, or a friend who might be able to give you a fair assessment from, just looking at the property and exploring the property when you're going to visit, to do the site visit, before you go into agreement with the seller, which involves some down payment being made. Do that. It's very important to ensure that you have that idea of what the property might be worth before you go into that obligation with the seller. Because if you do an assessment, if you do an appraisal after you make a down payment to the seller and sign the agreement, and it comes back that that appraised value is less than the asking price, you are going to be in problems. You're not going to be able to get the financing you need from the financial institution. They may require you to add more assets as collateral to be able to secure the same loan, when you could have avoided all of that by just knowing beforehand that is a good deal. So in general, appraisal values, very important. Take them seriously, and we'll talk more on our next segment. So I'll see you all.